Tina Mitchell here with your money chat. When I looked at the bond market on Thursday morning, a quote came to mind: "A rainbow is most beautiful after a storm. Be the rainbow." The consumer price index CPI was released and was higher than the market expected. This of course further undermines the Fed's effectiveness to handle inflation. The market reaction was an obvious one: more pain ahead. There's no sugarcoating it. The 10-year broke 4% upon the release. Dark inflation read, but dawn should be coming. The September CPI report showed that overall inflation increased by 0.4%, which was double the 0.2% expected. Year over year, inflation declined from 8.3% to 8.2%, but it was expected to decline 8.1%. The real story here is the core rate, which strips out food and energy prices. It increased by 0.6%, which was hotter than the 0.5% anticipated. As a result, the year over year core inflation increased from 6.3% to 6.6%, which was hotter than the 6.5% expected. Shelter rose by 0.7%, which matches the highest increase since 1991. Rents rose 0.8% last month and are now up 7.2% year over year, which is up from 6.7%. Owners equivalent rent, which tries to capture the rise in home prices but does not do a very well job, also rose 0.8% and is up 6.7% year over year, up from 6.3%. While the CPI rental costs are still catching up, real rent costs have started to come off their peak and slightly decline. Looking at more of the internals, energy prices fell 2% from a month ago, bringing the annual gain to 20%. Gasoline prices fell 5% and are up 18% year over year. Food prices, which make up 14% of CPI, climbed 0.8% in September, bringing the year over year gain to 11%. Medical care costs were also a main factor as they rose 0.8% last month and 6% year over year. While this report is negative for the bond market and mortgage interest rates, the worst is now behind us. The September reading is the last low figure from 2021 that needed to be replaced. Going forward, the comparisons get much tougher, and I expect inflation to start dropping, which will help mortgage interest rates. On the Fed minutes, the minutes were most hawkish. Many said that the Fed needs to continue tightening even as the labor market slowed. Cost of taking too little action overweighed the cost of doing too much. Once a restrictive level of the Fed funds rate is reached, it's needed to keep it there for some time. On the slightly dovish side, several said that the Fed needs to collaborate the pace of tightening with the risk and the adverse effect on the economy, and that it would be appropriate at some point to slow the pace of increases. It's early in the cycle and the market is still digesting the news. From here, we will have to weather out the market. We might have a fighting chance of recovering. We'll see how the dust settles after the market continues to respond. Just don't forget rainbows. Tina Mitchell here, and that is your money chat. Coming up